Hi folks, Dr. Miller here, welcoming you to our week 5 session at Financial Management, University of New Hampshire. This week we go through chapters 10, 11, and 12, have the fourth discussion forum. Here we also have to complete our midterm exam covering chapters 1 through 8 and submit our minor project. As I look at the content, we touch on some very important aspects concerning risk and return, lessons from market history. Key concepts about risk and return. First, I want to encourage you to learn about your own risk profile, your own risk propensity, and what risk really is. Taking calculated risks is an important part of our growth and professional development. Here we learn how to calculate the return on investment, and we should understand both the concepts of standard deviation and how to calculate the risk or standard deviation of an investment's returns. And you should be looking at some of the relationships, the historical risk and return relationships on various types of investments. For example, bonds offer a lower return over time than stocks do over time. Let's see what else we have here. Also, in terms of risk and return, we look at what's called the capital asset pricing model. Here we learn how to calculate the expected returns, and I did want to point out that the term expected return relates to what has happened on average in the past. Expected returns certainly relate to what we expect to happen, but an expected return does not necessarily mean it has to be an actual return. Also, we touch on a very important concept of diversification, whether it's portfolio diversification or a security diversification. Diversification seeks to increase our return per unit of risk. Diversification is a very simple strategic construct. However, it's also extremely powerful. Whether we have economic diversification, asset diversification, cash flow diversification. We come to understand the systematic risk principle as well. The systematic risks relates to the risk compared to the market, the volatility compared to the market. Here we touch on the concept of beta and understand how portfolios or securities may be selected on the basis of their systematic risk. The characteristics of individual securities that are of interest to us include the expected return, as I had mentioned, and the variance and the standard deviation of the securities. In Chapter 12, we touch on the relative importance of systematic and unsystematic risk in determining a portfolio's return. We also want to compare and contrast the capital asset pricing model, or the CAPM, and the arbitrage pricing theory. Arbitrage pricing theory arises if an investor can construct a zero investment portfolio with a sure profit. In terms of arbitrage, arbitrage is largely a quantitative construct where the investment community is using computers computers that are programmed by quant-minded individuals, so that the computer searches the markets for arbitrage or mispricings and helps the investor take advantage of them. In efficient markets, profitable arbitrage opportunities disappear very quickly in a matter of seconds. All right, that basically summarizes our learning opportunities and concepts for week 5. Enjoy our learning activities. Thanks.